All right, so we're ready. Let's update our audience on the market update on the industrial real estate market here in Miami. Seth, so what do you have?
Yeah, another active quarter. Vacancy is down again at 2.3%, the entire county, which is well below the national average. Net absorption is at 6.3 million square feet for the trailing 12 months. And that's actually down from 8.1 million square feet for the prior period. So that's just another massive quarter of absorption, even though it was down from the prior year. The big number that sticks out to me is the construction, what's going on in construction. Right now we have 7.9 million square feet under construction, half of which is already pre-leased. 3.9 million square feet is unspoken for. So let's put that in context. If that 3.9 million square feet was delivered tomorrow, that would only raise the vacancy rate to 3.7%. That is unbelievable. The national average right now is 3.9%. So even with all the available space that's coming online, there's just such a massive demand for industrial in South Florida. And it also speaks to the huge land constraints that we have in this market.
Yeah, I mean, year over year growth here has been close to 20% year over year growth, which is above the national average of 9.9%. So, I mean, industrial is still rampant. We're still, I mean, I think we have the highest rents and sale prices in the Southeast, just given the land constraints.
Yeah.
I mean, we're at averaging $250 a square foot.
Yeah.
That's insane.
What's the national average is
National
150
average
a
is
square foot?
150 a foot. So, I mean, South Florida is hot, and we're the most expensive right now as far as price per foot on sales, and I think leasing as well. We're averaging about $18 a square foot on the leasing side as an average. That's the market average. Logistics is a little bit under, about $17, I would say, $17.50.
Mm-hmm.
Let's go over some of the transactions that happened, that took place.
Before we do that, talking about the future, if we can look into the crystal ball, the employment numbers came out today. Another strong period for employment. And the unemployment is down, and what everyone's thinking is that's going to encourage the Fed to raise rates again. The big question is, are they going to raise it at the same rate at 75 basis points as they have been, or are they going to cut the amount of interest rate raising that they're going to do? I think with these employment numbers, it's going to encourage the Fed to raise interest rates for a continued period of time. I mean, Jerome Powell has said that until he can bring employment down, he's not going to give up. He's gone full Volcker, as everyone's saying. Now, how long is that going to last? That's the big question. So what that's going to do to our market, obviously, is if businesses are laying people off, unemployment is going up, that means that they're not going to have the revenue in order to pay the higher rents. Can a business sustain 20% rental rate growth over the next 5 years? I don't think so. We'll see how long these trends continue, but for right now, it's still up and to the right.
No, it's still up. I believe it's going to be stabilized, though. I don't see it growing much more. Maybe another 5%, I'd see it stabilizing, however, the next few quarters.
I mean, the land constraints alone, you just can't build enough space to,
vacancy tells you it all.
Yeah.
Vacancy says it all. So you're at 3% vacancy. I mean, there's just no land. So supply and demand.
Yeah.
Let's go over the largest lease transactions this year. I have as number one the FedEx Ground. That was repped by Colliers. That's on 103. I'm sorry, that's in Medley, 10300 on 121st. FedEx Ground. That was 501,000 square feet. That's a monster lease right there. That was inked.
Deal.
Oh, you also have Freeze Pack. That was first quarter as well. That was repped by Cushman and Wakefield.
Freeze Pack's another interesting story out of Pennsylvania, Philadelphia. They're in massive expansion mode. They just opened in Jacksonville. They have a new facility in Philadelphia. They opened here in Hialeah Gardens. they've partnered with BG Capital, and they're in massive expansion mode. It's a really great company.
Great company. They're in expansion mode, for sure. That's 300,000 square feet. They're also in Medley, up on Northwest 16th and 102nd. That was a beautiful cold storage building.
Yeah.
That was by Bridge, right? That was the spec that Bridge did. The first spec building here in South Florida, Miami, on a cold storage. First cold storage spec building. So on construction, due to the lack of available buildable land in Miami, developers typically focus on constructing smaller or mid-sized industrial facilities. The average industrial property built in Miami since 2010 is about 100,000 square feet, well below the average of major national distribution markets like Atlanta, Dallas, Fort Worth.
I think it speaks more to what we've been talking about, the lack of land. That's going to be coming up more and more, and going to influence all the numbers in our market from here on out. There just isn't enough land. Now, one thing that we're going to touch on a little bit is the South Dade Logistics and Technology Center, which is going to add 5.5 million square feet of industrial down south. That project hasn't started yet, but we'll touch on that in a little bit. So again, lack of land is the theme, and it's going to continue to be.
Yeah, there's right now 36 buildings under construction right now in our submarket. We have in Miami-Dade, there's 12 outlying Miami-Dade, which totals about, 200 or 2.6 million square feet, which 2.2 of that is already pre-leased. In Medley, you have 5 buildings under construction. That's 861,000 square feet, which 400, half of that is already pre-leased.
Yeah.
I mean, so activity remains strong on the industrial side. So
I mean, all in total, 7.9 million square feet. Like you said, half of it is pre-leased. So even if we delivered the rest at 3.9 million square feet tomorrow, it would only increase the vacancy to 3.7%. So, which is still below the national average. So when you have a current vacancy of 2.3% and the new supply raising it to 3.7, again, there's no land.
that leads us into sales. Let's talk about sales a bit.
Yeah.
Sales, while the rising rates throughout this year caused some friction between the buyers and sellers, I think it could lead to a slower market now. Obviously, I think I've seen sales slow down now. Obviously, sellers don't want to pay. Sellers don't want to sell anymore, and they still think their property is worth what it was worth a few months ago. And buyers obviously are kind of forced with the rates, at where they're at. So the cost of debt has caused buyers to kind of hold back and wait, and sellers are still think their properties are worth what they're worth a couple of months ago. So
yeah, I remember back in June, there was a week where the Fed raised the interest rate, and every conversation we had with a buyer was, no, we can't do anything. Why are you calling us with this? We're pencils down.
Yeah.
The number of times that I heard pencils down was
I've never heard it so much. I've never heard it so much this year.
Yeah.
Pencils down. However, there's some players out there.
Yeah.
There's some family offices right now that are stepping up to the plate, and I'm making some deals work. Some 1031s out there that sold, and they're buying cash. They're buying at a hefty price, but they're betting on rates coming down in the next couple of years.
It's a really interesting environment. A lot of the players are out, but some are still active. I think to speak to what you were saying about the bid-ask spread between buyers and sellers, up until this point, sellers have been getting an ever-increasing purchase price offer every week. They've been getting higher and higher offers. So in their mind, their building is worth more and more. But the number of offers has dropped off the face of the earth. Buyers are not active. They're handcuffed because of the rates. Deals are retrading mid-contract.
So easy for a deal to fall apart right now.
Yeah.
Just because there's so many little things that can go wrong, and anything goes wrong in today's market can cause a deal to go south quickly. That leads to another topic internationally right now. What's going around the world? People are saying that Miami is going to kind of, is going to feel the impact in my personal opinion, I don't think so. I think we just have so many, the dollar's strong now, causing the economies in like Colombia. You have obviously Venezuela and all these other places around the world, Ukraine, what's going on in Ukraine and Russia. All that I think is going to force people to just dump money here in the U.S. just because even if it's not even making money, even if it's a 2% cap rate or 3%, they just want their money to be, not lose its value at the speed it's losing its value in these other countries. So I personally see a lot of money still dumping into the U.S., more so in Miami.
So, I mean, here's a great anecdote. So a buddy of mine works for a major construction company. They do all the big multifamily towers around town. This is probably a few months ago. He said that they're selling units before it's even constructed, and what they're seeing is a lot of Latin American capital coming in. And it's not investment banks, it's families that put their money together to buy a condo, and it'll sit there empty just because South Florida and to the bigger extent, US real estate is such a great store of wealth. So, these families want to get their money out of their currency and into dollars for obvious reasons. Look what's happening to the currency rate right now. And, it just speaks to your point about this being a great place to buy.
Let's look at sales. Let's talk about sales and the sale price, where we're at right now today. Out-of-state investors have been net buyers of Miami industrial assets over the past half decade, and national firms have deployed capital aggressively here over the past few quarters. Prologis, 14 million square feet, and Blackstone, 9 million square feet, boast the largest industrial portfolios in Miami, with those two firms alone owning roughly 10% of the metro's inventory. Those are the whales of the market.
Yeah.
Recent repeat sales highlight the substantial price appreciation for Miami industrial assets over the past several years. For example, the two buildings totaling 300,000 square feet in Aventura Industrial Center and North Miami Beach submarket, they changed hands in December of 21 for $59 million. That's $195 a square foot. The properties previously changed hands in 2012 for only $18.7, $62 a square foot at a 6.75 cap rate.
The good old days.
Wow. Yep. Average cap rates. What are the average cap rates in the market this past year?
So right now we're looking at 5.2 average cap rate.
Yep. And vacancies at sale?
8.8%.
And we have $228 a square foot average sales price on industrial this past year. That's average. You want to highlight some significant sales this past year?
Yeah. I mean, the big national news was Prologis buying Duke. That was a 674 building portfolio that traded for $23 billion. I mean, obviously not just the portfolio, but the company itself, asset management, their staff, everything like that. And that was for a combined total of 166 million square feet nationwide. A lot of buildings in our market traded at 11 buildings in our market were part of that portfolio.
Let's talk also PS Business Parks.
PS Business Parks.
Blackstone acquired in October, just recently this past quarter, and that was 501,000 square feet, and that traded for a whopping $143 million at approximately $285 a square foot. $285 a square foot, guys. So
for Class B.
Yeah, I would say Class B minus.
Yeah. But location, I mean, it's right by.
You're less than what, 2 miles from the airport?
Yeah.
I mean, you're in Doral.
Right on 826 and 836.
Great park. Yeah, you have Prologis right behind it, so.
Really well maintained too.
Mm-hmm.
So going more locally, also we had a major 12 building portfolio trade in Medley, and that was previously owned by the Los Angeles County Employees Retirement Association. TA Realty bought it for a combined total of $241 million at $207 a square foot. It was 1.1 6 million square foot portfolio, and the whisper price that it traded at as far as a cap rate was mid threes.
Interesting.
Yeah. So, and I talked to some people that were in the running to buy that. There was a lot of upside, a lot of rents that were under market. So it was a huge opportunity, huge win for TA Realty to go in, raise rents to market. I think even the majority of the in-place rent was 50% below market. So there was a lot of upside. So, while 3.5%, mid threes, sounds like a really, really low cap rate, with the value add that portfolio had, I think it made sense for that group. Jumping over to cold storage, there was a major purchase of Quarch Foods.
Yes, I remember.
So
Sale leaseback. Who bought that? That was
sale leaseback. So SunTrust Equities funding, and then also Trustco Bank. Also Truist Bank purchased that property. So at a sale leaseback, beautiful portfolio between the Miami location and another one in Louisiana. The Miami location in Miami Airport North was 178,000 square foot, trading at $333 a square foot. Now, I mean, that's well above the average, but it's also a major freezer building with a lot of outdoor storage and trailer parking. So it was a beautiful property, huge win for the buyers. That traded for $59 million. And I think it also, it's also kind of a market setting purchase for the cold storage market here in South Florida, because there's really not a lot of purchases that happen in that segment. I think the last one was $280 something a foot, with U.S. Cold selling to Vista Cold. There was a few building portfolio in Medley. So this sets the standard.
Yeah, I mean, listen, there's less than 2% inventory in cold storage compared to dry cold storage in all of the industrial market. So there's just not that much inventory on the cold storage side.
Yeah.
So, that's there's the average. There's an estimated of 900 cold storage warehouses in the U.S. So that's less than 2% of all industrial space.
So going along the cold storage news for this quarter, a big announcement between USB Asset Management and PGGM announced that they're raising $700 million in a partnership to construct large build-to-suit cold storage facilities in major food and transportation centers across the U.S. There are an estimated, like you were saying, 900 cold storage warehouses in the U.S. alone, less than 2% of all industrial space. Now, the average age of these buildings, these 900 buildings, is 42 years old. So there's a lot of old product. So there's a huge need for brand new construction. Because what happens with the old product is it's low clear heights. It doesn't make sense for the modern logistics supply chain. Cold chain needs high clear heights, lots of automation. So these older buildings really are not suitable for today's logistical needs.
Yeah, they're looking more for more cube space.
Yeah.
So the freeze pack was a perfect example. They had a great cube space. I think their height was, it was more than 32 foot clear.
Yeah.
So they took advantage of that. And because of where they were situated, it gave the advantage of last mile deliveries. Right now, because of e-commerce and the quickness of delivery from grocery chains, the last mile delivery cold storage is rampant right now. There's a high demand and a high need for last mile delivery on the cold space.
So I think that necessitates these kinds of partnerships. I mean, to give you an example of what the pipeline looks like for cold storage right now, we have 26 cold storage projects under construction, which are totaling only 7 million square feet nationally. That's just not enough space for how much we need. One thing to put color on that 7 million square feet is that 3.3 million square feet of it is speculative development. So that means just putting up a building and waiting for the tenant to come. A field of dreams approach, as they say. Another stat that to throw out why this is so important: 40% of all food loss is due to lack of storage space near where it's produced. So farm grows the food, they can only put 60% of that food into storage to ship out to customers. So that's a huge waste.
It's a huge waste.
You know, that should be a huge signal for developers like this, and people are listening. You know, huge signal to develop new buildings.
Absolutely.
You know?
So Lineage Logistics, the world leader in cold chain storage, they've raised more than $4 billion during the pandemic to fund and rapid expansion that has grown its overall capacity to more than 2.5 billion cubic square feet.
The juggernaut.
It's huge.
Yeah. Huh? The juggernaut.
Yeah, I mean they're leading the market right now. Americold, right after them, they went public in early 2018 and used the funding to fuel a rapid expansion, and which made their REIT the second largest global player in the cold storage arena, with over 250 facilities encompassing over 1.5 billion refrigerated cubic feet of storage.
Yeah, huge. I mean, and that disparity between the first and second place just shows you, 4 billion to 1.5 billion of cubic feet. That's a huge difference.
Huge.
And the third place doesn't even come close, U.S. Cold. So I also wanted to touch on Americold's earnings report, because right now they're the top group that is public, has publicly traded numbers, and their earnings report just came out with total revenue increased by 9.8% to $2.2 billion. Total NOI increased 8.4% to $507 million, and their core EBITDA increased 3.5% to $362 million, or 5.1% on a constant currency basis. They have to equal out the currency because we've had such big fluctuations the last year. So, I mean, that's just a huge indicator for where cold storage is going, the players behind it, and how big of a demand there is.
Yeah, cold storage remains strong. There's just no product out there. There's a high demand, like you said. The loss of foods and perishables, 40% is a huge number.
It's almost half.
That's almost half. So cold storage is very needed right now in I would say in most markets, but I would say in the Midwest. You also have a lot of demand in the Southeast, but there's just high demand right now in cold space, especially with the developments of e-commerce coming up. Last mile deliveries, it's just rampant right now. So it's a great asset type to be involved in and invest in, especially now with the downturn of the economy. I would say great asset type to invest in.
Yeah. No, I think the player who can win in this space is going to be the one who can bring down construction costs, because that's the big hurdle, right? These buildings are really complex. They cost a lot of money. So, I think that means investors are more hesitant to jump in, whereas with just, logistics, light industrial building, you can throw up some tilt walls and you're done. But with, cold storage, there's a refrigeration, you have to do glycol floors, make sure the insulation is correct, what's your clear height, who's your tenant, who's your user. It's more complex than just throwing up walls and putting up for lease sign. So the company that can go around that hurdle is going to win.
Yeah, I would say definitely have the right development partner in place for cold storage. Like you said, all the development costs makes it very competitive. So if you have the right development partner and operator, you're good to go.
Yeah.
So that's the cold storage update, as well as the real estate or industrial market update for South Florida in 2022.